What is going on, you guys, and welcome back to the channel. My name is Brandon, and this January will mark my 20th year of being a stock market investor. I know that's kind of ridiculous to say, given that I'm 29 years old, and you might be doing some math in your head about how that's even possible. I did get started super young, and while I do not claim to know it all, I have gotten really comfortable and gotten to a place where I am confident with my investments. And I wanted to compile what I believe are the 10 most important things for a first-time investor, maybe even just a beginner investor, someone who's just really looking to take this thing seriously coming into the new year. If you enjoyed today's video, please do drop a big like and let me know your thoughts down below. Feel free to share whether you agree or disagree. But the number one thing I want to talk about today, I actually believe is the biggest determining factor in your success over your lifetime as an investor. It comes down to how committed you are and how well you save and invest over the years. And what I mean by that is how much you actually are able to contribute into your account. I know that's not the sexiest way to start off a video, but I do believe that this is a variable that you have the most control over, whether you're saving a little, whether you're saving a lot. Investing is not a one and done, one-time situation where you put money in and you just expect that money to grow into something crazy. Instead, it's much more of a journey or a lifestyle that one decides to partake in. The decisions and actions that you take on a day-to-day basis in regards to prioritizing the amount that you save on a monthly or a weekly or paycheck basis, that input has the biggest, in my opinion, impact. Number two is having the right expectations from the get-go and understanding that making money via investing, it does take time. And if you're thinking about getting into investing because you can make this shorter term money or money over the near future, I think you're playing the wrong ball game. And I think it warrants either resetting those expectations or playing in a different field, because there is a very big difference, FYI, between trading and investing. Trading or day trading or swing trading, Forex maybe even, is an attempt to make money over a short period of time. Now that comes with a ton of risk, and the data suggests the vast majority of people that try this were either not made out for it, they don't have the time, they don't have the capital, you're probably gonna end up losing money. I'm not saying it's not possible, but for the vast majority of average people out there, it's probably not the right approach. That's the short-term way to play the stock market. Investing, I liken very much to planting a tree, right? It's like you put a seed in the ground, you plant a little tree, you don't expect much to come from that in the early days. In fact, you really shouldn't expect that, because where the wealth is built with investing is over decades and decades of compounding. Now, you may or may not have seen a chart like this before. The moral of the story is that your investments, they grow exponentially, meaning the longer and longer you're invested, the more you stand to benefit. Most of your money is made in the later years in life, and that's all because you started early. At the end of the day, I think you need to make sure you want to be an investor and come in with those right expectations. Number three, asking the question, what should I buy, or what is the best investment for me to buy, is asking the wrong question to begin with. It's an impossible question to answer when you understand that each and every individual watching this video is in a different situation. They're in a different scenario. The investment that may be best for you may be a completely poor decision for your neighbor or for your mother or father or child. Everybody's different. And instead, what a better question a beginner should ask themselves is, what are my priorities first? What am I aiming to achieve, or what am I hoping to get out of my investments? Doing a very strong self-assessment on ourselves. And then once we figure that out, finding the investment that best suits that goal or objective. Some practical examples of this is that you may be an investor who prioritizes income. You need your investments to spin you off income to live off of, or to fund your lifestyle. Maybe a younger investor is somebody who instead is prioritizing growth. They don't have as much money and they want to multiply or grow that money for their retirement. Maybe you're a 65-year-old watching this video and you've got a big chunk of money, an inheritance, or you've built up money some way, shape, or how. Well, maybe your point, your goal at that point is not necessarily to grow it, but to preserve that. And again, maybe spin off an income in a very safe and conservative way. Very, very different goals. The time horizon in and of itself is a term you'll hear, and you need to decide, where on that spectrum when do you feel you're going to need to tap into this money? That's a huge determining factor. Because if, for instance, you told me today, hey, Brandon, I have this goal of buying a home next year. I want to get into the housing market. I've got X amount saved up for a down payment. Where should I invest? I would probably frankly say in that case, you probably don't want to invest that in the equity market, or you don't want to invest that in stocks, because over a year, anything could happen. The market's way too unpredictable over a short time period like that. A year, in my opinion, is a very short time period. even extending out a couple years, I wouldn't feel comfortable putting that in the market to inch out a little bit extra return. You would maybe then look at products like a GIC, a high interest savings account, a very safe and conservative product, knowing that that's your goal or priority. If instead you told me, hey, Brian, I'm a 20-year-old and I know this money is earmarked for my retirement, I want to grow it as fast as possible. Well, in that case, you probably will certainly look for a basket of stocks and buying businesses and companies out there that will grow for you over the years. If I were to give you guys just a suggestion in terms of what is the best investment to buy, even though I said I don't like answering that question, I think an awesome place to start for beginners is looking at an S&P 500 fund, a basket of the 500 largest companies in America as a core, as a getting your foot wet and starting. Over time, you can look to maybe diversify or build up the portfolio. But I do think that is a very logical first step. Obviously, your risk comes into play, and again, your age and time horizon comes into play, because if you're a 50-year-old watching this, maybe you want to balance that with some fixed income or some safer assets and have more of a balanced approach. We'll talk about that actually here in the next point. Number 4, to build off that, and hopefully not contradict myself here, I believe the funds that you pick don't matter. Now, I need to be very careful about how that may be interpreted, because I don't want that being spun in the wrong way. They definitely do matter. But one of the most common questions I get is, should I buy VFV or should I buy ZSP? Or should I buy XEQT or should I buy VEQT? Which are essentially very similar products from different providers. And I very much liken it to that question of, do you personally prefer drinking Coke or Pepsi? Like, they're both colas at the end of the day. Yes, there might be slight differences and they might have a slight taste to those who have a very nice taste buds. But in general, Coke and Pepsi, same thing. XEQT, VEQT, same thing. When you break down funds in a similar category or group, you will notice slight differences, but the returns over long periods of times tend to be pretty darn close. And in fact, the longer and longer you stretch out those timeframes, if it's a similar category of group, well, let's just take the S&P 500 as a very clear example. Whether you're buying VFV or ZSP, they own the exact same thing. It's just one company's take on the product and another company's take on the product. Yes, there might be a slight difference in fees, like a basis point difference, or this one has such and such slight tweak to the strategy. But the longer and longer you stretch out the return performance, they tend to be very, very, very similar. Now, again, just to put the disclaimer out there, and I'll say this disclaimer now to begin with, like, I'm mentioning certain ideas and investments and ETFs and whatnot, but always do your own research and due diligence. That's disclaimer number 1. But in particular to this point, you do still need to select the right type of investment, from the previous point, that's going to get you to the goals. That is very important. That is critical. Is if you're an aggressive investor, you don't want to buy a conservative fund, or if you're a conservative investor, you don't buy an aggressive fund. But within their own little families, I wouldn't spend too much time worrying about the nitty-gritty of the minute details, because at the end of the day, they are all very similar to each other. Number 5, this is a good one. Take the time and do a financial projection if you haven't done that already. And if you're just like vaguely, investing for some future goal, or I want to grow my money, like, again, that's great and that works for some people. But when you can see the details and a more granular projection of how your money will grow on a year-by-year basis, or what you may end up with at the end of your investing horizon, it makes things so much more real. And the term for this is a compound calculator. There's a ton of them for completely free you can use online. I tend to use one called Get Smarter About Money. You can just search that up, compound calculator in Google. You can go in and punch in your exact details, your age, how much you have, how much you plan to invest. You can even actually use ChatGPT. I just tested it out prior to filming this. You can literally type in a sentence, ChatGPT, even ask it to generate you like a graphic. I said, hey, display this in a chart. It did it for us. There you go. But by doing this, at least, I can only speak from my experience, it makes things so much more real. In fact, a major benefit that I see as well is that it actually almost encourages you to invest more. When you go in there and you start messing around with the numbers and say, if I invest an extra $100 a month, an extra $200 per month, how will that impact me at retirement? The numbers are often a lot bigger than you would have ever expected. And you can almost reverse engineer and like work backwards to what are the actionable steps I can do today that's going to impact that. Number 6, here's another good one. It's automate the process of investing as much as reasonably possible. And that can apply to both just your savings, like in terms of paying yourself first at the beginning of the month when you get your paycheck, or twice a month whenever you get your paycheck, committing that automatically to your investment accounts. But you can even take it a step further and actually automate the investments in and of itself. And it boils down to this whole out of sight, out of mind mentality and really just helping you form that habit of getting, on a regular basis of continually investing, which brings it back to point number one, which I started talking about. I actually invest right now on a weekly basis. I have an automation set up with Wealthsimple where I just go in. I don't have to go in actually at all. It's truly automated where every week money comes out of my bank account and then goes in and buys the particular funds, all automated and all recurring. I don't have to do anything there. Now, it doesn't have to be weekly. That's just what I chose. It could be monthly. It could be every paycheck. You can choose the cadence that works for you. Some brokerages don't allow this, by the way. Like you can, double check with your brokerage. That's one of the big reasons why I personally made the switch to Wealthsimple. I like the fact that I can just truly automate it. But if your brokerage doesn't even allow automated purchases, that's fine. At a minimum, set up that pack, a pre-authorized contribution where money's going from your bank account into your investment account. So it's automated and out of sight as much as possible. Number 7, start investing with ETFs, then possibly, and I'll say there possibly, look to include individual stocks. And this is that whole debate of should I buy stocks or ETFs? For those that are very new, when they think of the stock market, they may just think of picking individual companies, right? I can go out and buy shares of Tesla and Nvidia and McDonald's and Walmart and build and craft a portfolio of individual stocks. That is an option, but you also could buy a basket of stocks, an ETF. The term ETF stands for Exchange Traded Fund. And essentially what you're doing is, you can buy a basket that within that one basket owns hundreds and sometimes thousands of different investments. So you can already start to think about the value that brings, whether it's from a diversification standpoint and not putting all of your eggs into one basket like Tesla or Nvidia, which again may work out for you, but that's just an overly risky thing to do, in my opinion, to concentrate all of your assets into one stock. You're diversified. If you're watching this far in the video, I think it's fair to assume you're either a beginner or possibly even first-time investor, like just getting started. And frankly, as a beginner, we don't have the expertise or experience or skill or knowledge to go out and research and pick individual stocks. So you could essentially buy a broad basket of them. This does tie into what I believe is the third very valuable aspect of an ETF is the passive approach, the passive hands-off approach, where again, you're not in charge of actively managing. Even if you did pick good stocks or you have managed to build a portfolio of individual stocks, you don't have to be monitoring them the same way that you would had you owned one basket that essentially did that job for you. This to me is the no-brainer, clear way that a beginner should enter their journeys in the stock market with a broad-based fund like this. Now, in time, if you have the care, the interest, maybe the knowledge which you've gained over the years from being an investor and you're finding yourself passionate about this, you absolutely could look to incorporate stocks into your portfolio, maybe small at first, maybe allocate 5%, 10% of your portfolio to a few of your favorite stocks. Maybe that evolves, down the road to one day managing a, portfolio of all individual stocks, but not right off the bat. That's like a progression that comes with time and as your experience grows, okay? Number 8, this may be an intuitive one, but I think it is a very timely one to mention, especially here in 2025, and that is be careful where you get your information from and who you get your information from. And this rule absolutely applies to me and this channel and this video. Pretty much anything that you consume online, especially now with like TikTok, a lot of people getting their, information from their Instagram, YouTube. One thing that is important to understand about algorithms in general and how people grow their online presence is that the algorithm favors, like the content that you end up seeing is often, it's not always the best because the boring, non-sexy advice or principles that someone may teach, those don't tend to get the views, which then tends to push it out to more people, right? It's like a negative feedback loop, if you will, versus when you have content that is hype, trendy, playing on people's FOMO and, people are making money in a shorter term fashion. That's what tends to get the views and that's what attracts more people in. There's a positive feedback loop. So just in general, I would approach really all content with a grain of salt, take the information in, absorb it, but just never take anything as gospel. For those that are new here, I'm one of the co-founders of the Blossom app. We're building a social media for investors. We're aiming to combat this. Of course, it's not perfect. And as with anything, do your own research, but we're building a social media platform for investors. It's an amazing place for beginners where you can actually see what real people are investing in, real investment activity, ask questions. And one very cool thing about our community is unlike a Wall Street Bets and Twitter and Reddit to some extent, which tend to be very short-term focused, on Blossom, like the biggest, most followed topics are like ETFs, index funds, dividends, passive income, beginners. So we've very specifically tried our best to build a community of people who are actually building wealth for the long term. Obviously, I'd hope to think you'd find good information on there, but you can let us know. It's free to download in the App Store. I'd love for you to check it out and follow me on there, by the way. My username is @Brandon to see what I'm actually doing in the markets. Number 9, should you do your investing at the bank / with an advisor, or should you do it DIY, do it yourself style? And during 2025, I very firmly believe that it's worth taking the time to learn how to do this on your own for a variety of reasons. And I know that that may seem overwhelming, that may sound very scary, and it may sound too big of a challenge. I could see that, but I can tell you from doing this for however long I have and helping people learn to invest and seeing all the people successfully doing it, it's not rocket science. It really isn't. And you are fully capable of spending the time to learn how to do this yourself and then applying that. And it doesn't have to be overcomplicated. One of the major reasons why I suggest this is if you just look at the fee breakdown, right? If you were to go invest with the bank, it would very certainly be putting you in a product like a mutual fund. And the average fee on a mutual fund, I don't know the exact number off the top of my head, but it sits somewhere in that 2 to 2.5% range. If you do it yourself, so DIY, you open up a brokerage account, you learn, you educate yourself, and you go out and pick an investment, you could buy a very comparable, almost identical basket or fund, an ETF, and the fees on that are a fraction of the cost. So 0.06%, 0.09%. Those numbers may not sound like a lot, but when you invest, larger sums of dollars, I can punch up some math on the page for you guys. It is a big difference. And then when you do that over decades of investing, that difference becomes more and more and more pronounced. Now, of course, you do also have the potential of messing things up when you do it by yourself. So it does require information and learning. And I'm not like opposed or overly against using an advisor. If you're someone who deems, I need that professional looking over me, I want that, well, that very well may warrant working with an advisor because you've done that assessment. You say, listen, I'm the type of person that needs that extra layer of support. Certainly, as your account grows bigger and bigger and you get closer and closer to retirement, let's say you've built up a bunch of money and you have more needs like planning for retirement, estate planning, you got $1 million in your account, well, then you have a lot more to lose. Then I would actually say it makes more and more sense to work with an advisor and pay the fee because they're the professionals. But for the vast majority of people who are just starting out with smaller dollar figures, it's not rocket science to go out and buy an ETF or build a portfolio and then again, let that do the work for you over the years. And that leads into our final takeaway, which is just a foundational lesson that I take with me when it comes to investing in general. And that is to keep it simple and not overcomplicate things. And being complex as an investor is not always better. In fact, I would argue in many times it's worse. And I can share my personal experience and story because over my years, I've done the full spectrum, right? Like I actually started investing with mutual funds, for those that don't know. Back in the day, mutual funds, ETFs. For many, many years, I managed a portfolio of individual stocks. So I was in charge of picking and managing about 25 different stocks. My portfolio right now is 2 ETFs, 2 broad-based funds where it's passive and I don't have to manage it at all. And there are an immense amount of benefits to a strategy like this from a return standpoint, statistically, the odds being in your favor of how that's going to, result for you over time. And then just the lifestyle of not having to allocate or dedicate X amount of time and stress and mental load to be worrying about your investments. The more simple you can keep it, often the better. And there's a couple of quotes that I want to finish off with. These are 2 of my favorite quotes actually by Warren Buffett. I don't know if the first one's by Warren Buffett. I think it is. But it goes something along the lines of, as an investor, learn to be okay with being average. Like it's a good thing to be average. And we always have this natural human tendency to want to outperform and to want to be better and to think we're smarter than the market or this investor or that investor. But actually what the data suggests is that if we can just settle and be, put our egos aside and be okay with average and being consistent over years and years and years, that's when we'll really benefit from the power of compounding. And it's a boring strategy, but it is one that will work over time. In my opinion, less chance of you blowing something up by going down a rabbit hole or experimenting with something. You can still experiment here and there. Don't get me wrong. Like you can still have a little bit of fun, but don't overdo it, right? The second quote is that investing is simple, but not necessarily easy. And there's a big differentiate, like I see a big difference in that phrase, that statement. Investing in and of itself, like the process of setting up a brokerage account and putting money in and building a portfolio of ETFs or even to some extent some stocks, just building a sound portfolio, it's not rocket science. It's actually relatively straightforward and simple. Again, it may feel overwhelming at first, but I promise you it's not. But that doesn't mean that the investing journey is going to be easy. And this entire session, obviously I'm trying to paint a positive light on investing. I want you guys to be jazzed up and excited and like geared to go for investing, especially those who haven't started in 2024, so going into 2025. That's not to downplay that the journey doesn't come with its ups and downs, and the psychological aspect of investing and the emotional tricks that your body and mind play on you when you're seeing, big swells and FOMO and market crashes. It doesn't make it easy. Right? It's simple, but not easy. And, if you guys have stuck through this entire video, first of all, let me know. That'd be awesome. But I could literally do, a video on my top 10 psychological or like mindset, market psychology takeaways that I personally find to be the most helpful for me. Again, that's a whole nother thing. But in my opinion, it's a very important thing as well. But yeah, the takeaway to wrap up this video, guys, thanks again for sticking through this, is if you are new to investing or a beginner, you totally can do this in 2025. Hopefully these tips, while although not the flashiest out there, I hope they will guide you in the right direction, point you in the right direction. And of course, always do your own research and due diligence. But yeah, make 2025 the year that you either get started, or if you're a beginner, you dial into it more, because it's worth the attention. It's worth the time to take this more seriously. There's really no other field out there, maybe other than like your health and maybe relationships, I guess, that are as important as getting this stuff figured out as early as possible. So let me know what you guys think down in the comment section below. Are there anything in this list that you would have included or excluded? I definitely would love to know. If you're not already following the channel and you enjoyed the video, subscribe, hit that like button, and again, download Blossom. Download our app Blossom, it's free. You can search it up in the App Store. Follow me, my username is @Brandon. I would love to see you on there. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.